Hello everyone and welcome back to Markets Analysis. In the world of finance, a name can mean everything. Ketan Parekh, once celebrated as the wizard of the Wall Street, the man who turned stocks into gold. But beneath the glittering facade lay a dark secret, one that would spark SEBI's most intense 30-month investigation into a multi-crore scam. Ketan Parekh became more famous for wrong reasons in the early 2000s for one of India's biggest stock market scams. He manipulated the prices of selected stock called the K10 stocks, infamous market manipulation in the early 2000s, by artificially inflating their value. When the market crashed in 2001, his actions caused huge losses for investors. Parekh was arrested and banned by SEBI from trading for 14 years. This history of market manipulation made him a familiar name for regulators when his name surfaced again in this recent scandal. At the height of his career, Parekh was a force to be reckoned with. He was a man who could single-handedly move markets, but history remembers him less for his brilliance and more for his audacity. Ketan Parekh became notorious during the 2001 market crash when his manipulation of certain stocks called the Ketan stocks was exposed. He had artificially increased their prices by repeatedly buying and selling the same stocks, creating a bubble. When the market crashed, the investors lost huge amounts of money. SEBI investigated and banned him from trading for 14 years. This event marked the start of Parekh's complicated history with SEBI as he continued to be under their watch for years. Fast forward to 2021, the stock markets were buzzing again, but not in the way you would expect. Certain stocks were moving too perfectly, with some entities always ahead of the curve. Whispers began circulating in financial circles. It wasn't luck, something much bigger was at play. SEBI got involved when unusual patterns in stock prices and trading volumes began to emerge. Certain stocks showed sudden irregular movements that didn't match market trends, raising red flags. Along with these irregularities, there were whispers of insider deals and coordinated trading among specific entities, suggesting that market manipulation might be at play. These suspicious trades drew SEBI's attention, prompting a deeper investigation to uncover the truth behind the activity. What SEBI unraveled next was like peeling back the layer of an onion. At the core was Ketan Parekh, orchestrating a well-oiled machine of market manipulation. It wasn't just him. A network of brokers, firms, and accomplices worked in tandem to pull off what's known as front running. Front running in the stock market works like this. Imagine you are about to buy a large number of shares of a company. Let's say ABC Limited, the name of the company. Before your order goes through, a broker who knows about your trade uses this insider knowledge to buy ABC Limited shares first. When your large order causes the stock price to rise, the broker sells their shares at a higher price, making a quick profit. In this case, entities like Salasar Stock Broking played a key role, where physical systems were allegedly used to execute trades based on insider information. These brokers and their accomplices exploited private knowledge about upcoming large trades, information that regular investors had no access to. By acting on this information, they could buy or sell stocks ahead of the market, locking in profits unfairly while leaving ordinary investors at a disadvantage. Over the next 30 months, SEBI dived deep into this case. They tracked countless transactions, decoded WhatsApp chats, and scrutinized referrals between brokers. The findings were damning. SEBI's investigation uncovered the shocking extent of Ketan Parekh's scam. Parekh and his network made crores in illegal profits by using insider information to predict stock market movements. This wasn't a simple operation, it was a carefully orchestrated scheme that resembled a multi-layered spider web, with money and trades flowing through various entities and individuals. Here is how the scam worked step by step. In the first step, the insider information was leaked. Parekh's network gained access to confidential information about large upcoming trades and market trends. The second one, brokers execute trades. Entities like Salasar Stock Broking use this insider knowledge to place trades ahead of the broader market. These brokers acted as the first layer in the scam, executing trades designed to manipulate stock prices. The third step is price manipulations. A network of Ketan Parekh's partners coordinated with the brokers, engaging in circular trading or other methods to create artificial demand for specific stocks. This pushed up prices and trapped unsuspecting investors. The fourth step, profits funneled back to Parekh. Once the stock prices were inflated, Ketan Parekh and his network sold their shares at a significant profit. A portion of these illegal gains were then funneled back to Parekh himself, who orchestrated the entire operation. The fifth step is the retail investors suffer. By the time retail investors, people like you and me, entered the market, they were unknowingly buying overpriced stocks. When the bubble burst, they were left with heavy losses. This flow of money highlighted SEBI's findings, a calculated scheme driven by greed exploiting the trust of ordinary investors. Parekh and his network treated the market like a game, with crores of illegal gains lining their pockets while leaving the broader market and its participants in disarray. Here is how the scam worked. Parekh allegedly received insider information about upcoming stock movements. This information was relayed through trusted partners and brokers who could execute trade ahead of everyone else. The result, huge profits for Ketan Parekh and his circle, and huge losses for everyone else. The scale of profits in this scam was massive and shocking. Entities connected to the scam reportedly pocketed illegal gains of 8.06 crore and 19 crore, a combined total of over 27 crore rupees. These profits didn't came from honest trading or smart investments, but from exploiting insider information and manipulating stock prices. Here is how it worked in simple terms if you did not understand until now. Imagine knowing the result of a cricket match before it's played and placing bets accordingly. That's essentially what the brokers and partners in this scam did. They used confidential information to predict market movements, bought the shares before prices rose, and sold them for guaranteed profits. For Ketan Parekh, this wasn't a one-off event. It was a part of calculated strategy, a game where he manipulated the system for his benefit, leaving out ordinary investors to bear the losses. This staggering amount of money highlights the deep impact such manipulation has, not just on individuals, but on the integrity of the stock market as a whole. But every scheme has its end. SEBI's finding culminated in a scathing 188-page interim report. The regulator named Parekh and several others prima facie guilty of market manipulation. SEBI's response to the scam was swift and decisive. It demanded that the unlawful gains of 8.06 crore and 19 crore made by those involved in the scam to be returned. These amounts weren't just numbers, they represent the ill-gotten profits earned at the expense of ordinary investors. SEBI's goal wasn't only to recover the money, but to send a strong message that such manipulative practices won't be tolerated. Entities like Salasar Stock Broking played a key role in the scam, serving as the brokers who executed the fraudulent trades. SEBI charged them, along with individual partners who are close aides of Ketan Parekh, so they played their part in the scheme. These individuals worked behind the scenes, using insider information to manipulate stock prices and make illegal profits. But SEBI didn't stop with just recovering the money. The regulator imposed hefty penalties and sought to hold everyone involved accountable. By doing so, SEBI aimed to make an example of the culprits and restore faith in the fairness of the stock market. This case served as a warning to others in the financial world. Attempt to game the system would come with severe consequences. For Parekh and his partners, the fallout was swift. Appeals were filed, illegal battles began, but the damage to their reputation was irreversible. The scam didn't just hurt retail investors financially, it shook their trust in the stock market itself. For many ordinary investors, the stock market is seen as a place to grow their hard-earned money through fair and transparent trading or investing. This scandal, however, exposed the darker side of the market, where manipulation and insider deals overshadow fairness. Retail investors who unknowingly bought into manipulated stocks suffered significant losses. They were left holding overpriced shares that plummeted in value once the scam unraveled. For these investors, the scandal wasn't just about the money they lost. It was about realizing the system they trusted could be rigged against them. This erosion of trust had a ripple effect on the broader market. When investors lose faith, they pull back, reduce participation in the market, and slowing its growth. It also raised serious questions about the effectiveness of regulators and the ability of authorities to protect small investors from powerful manipulators. In the end, scandals like this hurt everyone, making the market less accessible and less appealing for the average person. The story isn't just about greed, it's a cautionary tale for investors everywhere. To protect yourself from scams like this and safeguard your investments, here are some practical tips you need to follow. The first one being diversify your investments. Don't put all your money into few stocks or a single sector. Spread your investments across different industries, asset classes, or geographies if possible. This way, even if one stock or sector underperforms, the impact on your overall portfolio will be minimized. The second tip being avoid blindly following market gurus. Be cautious of anyone promising quick profits or insider tips. Even well known names in the market can be wrong or manipulative. Always question the source of the advice and verify it independently. The third tip is to stay informed about regulatory actions. Keep an eye on SEBI's updates and circulars. Regulators often flag suspicious activities or entities, and stay aware of these warnings. And staying aware of these warnings can help you avoid trouble. The fourth tip is to focus on fundamental research. Don't invest in a stock just because it's trending or someone recommends it. Look into the company's financials, management, and growth potential. Understand what you are investing and why you are investing. And the final tip is to have a long term perspective. Avoid getting swayed by short term market movements or hype. A steady long term approach to investing is often more rewarding and less risky. By staying vigilant, doing your own research, and spreading your risk, you can protect yourself from falling victim to scams and you can build a solid financial future. So, Ketan Parekh's story serves as a stark reminder no matter how powerful you think you are, the truth always finds a way to surface. And for the markets to thrive, trust must be its cornerstone. So, what are your thoughts on this scam? Share them in the comments below. Don't forget to like and subscribe for more stories that uncover the truth behind the headlines. I will come back again with another interesting video. Until then, have a great time.